From Dubai, we have with us Mr. Mehta, the senior analyst at Century Financial. These decreases on the futures, are they temporary, waiting for a clearer pictures regarding China, or are they decreases that will stay with us until the 14th of December, until the Fed makes its decision, or we wait for the minutes of the Fed in its last meeting?
Yes, hello, hi. To start with, the current market downfall that we are seeing in US futures is primarily on account of the sharp increases in COVID cases across China. So China just reported its first COVID death in over last 6 to 7 month period. So the risk markets are absolutely roiled because of this fact. And if we move a step back, that is into last week's trading, everyone is nervously expecting for what's going to be the outcome of the December 14th FOMC meeting. Now, markets have largely priced in a 50 basis point rate hike by the US Fed with 80% probability being assigned to the same. What would be interesting to see is what would be the overshoot language that the Fed is willing to use. So right now, Goldman Sachs, all the major economists, all the major central bankers are expecting the Fed pivot somewhere to come around mid of next year or end of next year, depending upon how inflation bottoms out. But the real pain would be to see how aggressive the Fed is going to go before that in trying to tame the inflation bull. So this Wednesday's FOMC meeting minutes might well again reiterate the hawkish pledge that the FOMC has reiterated over the last 6 to 8 months. So wouldn't be surprised if some of the FOMC members again come out even with a 75 basis rate hike in the December meeting.
Do you think that it's going to be more dovish compared to what we will, read in the Fed's minutes, and this personal consumption expenditure index? Goldman Sachs expect that it will be 2.8% after 1 year. Now it is more than 5%. So expectations that it will be by half going down. Do you think these expectations are too optimistic, and based on that they will build the decreasing pace?
Right. So the Goldman Sachs expectation is primarily based on the assumption that the services inflation, that is basically comprised of rent, medical, healthcare, and transportation services, that cools down over the period of next year. But I would say it's too early to say that the core PC index, that is stripping off the volatile energy, automobile, and food prices, is going to come down so much drastically. We will need to see what the early trends are in Q1 of 2023 before we can make such aggressive bets of PC inflation coming down. Now, as far as the question regarding the slowing of the pace of rate hikes is concerned, should the core PC inflation actually drop down below 3.53% by H1 of 2023? It will definitely be turning out to be a big respite for the markets because the entire Fed's narrative might come to a halt. The Fed might even look at halting the pace, neutralizing it towards this target range, and accordingly go or sound more dovish after that.
In order to have a clearer picture about neutrality, what about the equity markets? Do you think they will keep this movement within that range? Do you think that markets will try to find a direction until the end of this year? What will dominate the thinking of the investors in the markets? Do you think it's going to be a bear market?
To start with, we've already entered a secular bear market, to be very frank. Now, what's going to be the most puzzling point as far as an investor or retail trader is concerned is at which point does the recovery in tech stocks actually start? So, we are talking about the benchmark NASDAQ 100 index, major stocks like Apple, Facebook, Amazon, which are down in the range of 40 to 45% this year. So the early assumptions are: should the inflation come down? Should the Fed actually pivot? Should the pace of rate hikes slow drastically? Then this is the sector that is likely to dominate the investor's mind. The moment you start seeing recovery in the tech indices, tech stocks, that is where you could see the overall risk market momentum again taking a big upside swing.
I would like to thank you, Mr.
Thank
Bhavik
you.
Mehta, the senior analyst. Thank you very much for being
Thank
with
you.
us.